somewhere in a quiet office in Tokyo, a fund manager just made a decision that will quietly raise your mortgage payment. You did not vote on it. You never met this person. You have probably never even thought about Japan when you signed your loan papers. But the math they run every morning now favors keeping money at home instead of sending it to America. And that single shift in logic is already moving through the global bond market towards your bank account. For 30 years, one country did something almost nobody noticed, and that quiet habit helped keep American borrowing cheap for an entire generation. That habit just broke. And what happens next could reshape how much every homeowner, every car buyer, and every retiree in America pays for the rest of this decade. Here is the number that started this story. Japan holds more American government debt than any other country on earth, more than China, more than the United Kingdom, more than every rich Gulf state combined. For 3 straight decades, Japanese insurers, pension funds, and banks bought United States Treasury bonds with almost robotic consistency, adding tens of billions of dollars to their holdings nearly every single quarter. Then, in the first 3 months of 2026, something changed. Japanese investors became net sellers of American government debt for the first time in over a year, offloading close to $30 billion in United States bonds. And the part that should worry anyone paying attention is not the total amount. It is the shape of the selling. January was mild, February nearly tripled it. March nearly doubled February again. This was not a one-time trade. This was a pattern gaining speed with every month that passed. To understand why this matters, you need to go back to a decision Japan's central bank made decades ago, one that most people outside of finance never think about but that quietly shaped the entire global economy. Beginning in the late 1990s, the Bank of Japan pushed interest rates down toward zero and kept them there for most of 3 decades. At times, the rate went negative, meaning banks were actually charged a fee for holding onto cash instead of lending or investing it. For a Japanese pension fund or insurance company sitting on hundreds of billions of dollars in assets, a domestic bond paying almost nothing was useless. Their retirees still needed income. Their policyholders still needed payouts. So these institutions did the only rational thing available to them. They sent their capital abroad, and the biggest, safest, most liquid destination in the world was the United States Treasury market. This is where investor psychology becomes just as important as economics. Once an institution builds a habit of buying a certain asset for 30 years, that habit becomes embedded in its entire operating structure. Actuarial models get built around it. Risk committees approve it year after year without a second thought. Entire departments exist to manage it. Behavioral economists call this the endowment effect combined with institutional inertia. The tendency for large organizations to keep doing what has always worked long after the original reason for doing it has faded. Japan's treasury buying was not just a trade. It was a habit baked into the bones of its financial system. Which is exactly why the fact that this habit is now breaking should be taken seriously. Institutions this large and this cautious do not change direction on a whim. When they do move, it usually means the underlying math has shifted so dramatically that staying the course would be the reckless choice, not the safe one. And that is precisely what has happened. Starting in late 2025, the Bank of Japan began raising interest rates for the first time in decades, eventually pushing its policy rate to 1% by the middle of 2026, a level unseen since the mid-1990s. At the same time, the central bank sharply reduced how many government bonds it was buying each month, nearly cutting its purchases in half within about a year and a half. When a central bank stops artificially holding yields down, the market takes over, and the market has been demanding a lot more. Japan's 10-year government bond yield climbed to its highest level since 1997. Its 30-year bond touched a yield never recorded before for that maturity. This is where the story turns, because for the first time since before the 2008 financial crisis, Japanese institutions can now earn noticeably more money keeping their capital at home than sending it to America, even after accounting for the cost of hedging currency risk. Roughly 1 percentage point more. That may sound small, but for an institution managing hundreds of billions of dollars, 1 percentage point is not a rounding error. It is hundreds of millions of dollars in additional annual income simply from switching where the money sits. But this is where things get interesting, because the story is not just about interest rates. It is about survival instinct inside Japan's financial regulatory system. In April 2025, Japan introduced a new insurance capital standard requiring companies to value their assets and liabilities using current market prices instead of older accounting methods. Under the old rules, an insurer could hold a long-dated foreign bond for decades and mostly ignore its day-to-day price swings. Under the new rules, every movement in global bond yields now shows up immediately on the company's balance sheet, directly affecting how healthy or fragile that company appears to regulators. Suddenly, holding long-duration foreign bonds is not just a yield decision. It is a solvency risk. Japanese insurers who once happily held 30-year American bonds are now shortening their exposure, some publicly stating they have largely stepped away from ultra-long maturities altogether. Two forces, one purely financial and one purely regulatory, are now pushing in exactly the same direction at exactly the same time. Now here is the part almost nobody explains clearly. The part that turns a Tokyo boardroom decision into a number on your own mortgage statement. United States Treasury yields are not just a Wall Street statistic. They are the foundation price for almost every form of borrowing in the American economy. 30-year fixed mortgages are priced directly off the 10-year Treasury yield. Auto loans, corporate bonds, student loan refinancing, business expansion loans, all of it sits on top of this same foundation. When a massive, historically reliable buyer like Japan steps back from that market, the United States government still has to sell the same amount of debt. It simply has to offer higher yield to attract someone else to buy it. That higher yield ripples outward into every corner of consumer and business borrowing. It already has. The 10-year Treasury yield climbed to its highest level in a year during the spring of 2026, and the 30-year yield crossed 5% for the first time since 2007. A year that, in hindsight, sat right on the edge of the worst financial crisis in living memory. There is also a second, more technical channel at work, one that most retail investors have never heard of but that professional traders watch closely. It involves something called risk parity funds, large institutional strategies that split money across stocks, bonds, and other assets based on how volatile each one is, rather than by simple dollar amounts. When volatility in Japanese government bonds spikes sharply, as it has during this period of rapid yield increases, these risk parity funds are mechanically forced to sell some of their other holdings to keep the overall portfolio balanced. Analysts at a major global bank have warned that this mechanism alone could trigger tens of billions of dollars in indirect United States Treasury selling, not because anyone in Japan sold anything, but because volatility in one market forced automatic rebalancing in another. This is how modern global finance works. A shock in one country's bond market does not stay contained. It moves through algorithms and risk models until it lands, quietly and invisibly, in the borrowing costs of an ordinary family thousands of miles away. So what does this actually mean in dollars for a normal person? Analysts estimate that a sustained shift of this size in Japanese demand could push the 10-year Treasury yield somewhere between 20 and 50 basis points higher than it would otherwise sit. On a typical $400,000 home loan, a 50 basis point increase adds roughly $130 to the monthly payment. Stretch that across a full 30-year mortgage, and the extra interest paid over the life of the loan approaches $47,000. Money quietly transferred out of an American family's pocket because of a policy decision made in Tokyo that most of that family will never hear about on the evening news. But before this turns into a story about panic, it deserves an honest counterpoint, because the full picture matters more than the scary headline. $30 billion sounds enormous, but it represents only around 2.5% of Japan's total Treasury holdings. The United States bond market remains the deepest, most liquid market on the planet, and history shows that when one type of buyer steps back, other buyers, hedge funds, pension funds, even foreign governments looking for safety, tend to step in, just usually at a higher price. There was even a brief pause in the selling pace during April 2026, a reminder that these flows rarely move in a perfectly straight line. Large institutions with liability-driven, multi-decade planning horizons do not panic sell in a single quarter, and Japan's finance ministry has every incentive to manage this transition carefully rather than let it spiral. Still, the direction of travel is hard to ignore. Bank of Japan officials have signaled openness to further rate hikes through the rest of 2026, with some board members openly stating that rates should eventually climb toward a more neutral level roughly double where they sit today. Every additional hike widens the gap that is already pulling Japanese capital home. Meanwhile, The yen has been trading near its weakest levels against the dollar in more than 4 decades, making imported energy and food more expensive inside Japan and adding even more pressure on the central bank to keep tightening. What began as a quiet accounting rule and a slow climb in interest rates has become a feedback loop, one where each new piece of economic pressure inside Japan makes it slightly more attractive to bring capital home, and slightly less attractive to keep it parked in American government debt. This is not a crash story, it is a slow, structural rewiring of a financial relationship that quietly shaped global interest rates for 30 years. It will not show up as a single dramatic headline. It will show up gradually, in mortgage rate quotes that sit a little higher than they otherwise would, in auto loan offers that feel slightly less generous, in retirement account statements that reflect a world where borrowing costs no longer enjoy the invisible subsidy they once did. The most important financial stories rarely announce themselves loudly, they arrive quietly, buried in a foreign central bank's policy statement, and only become visible months later in the number printed at the bottom of someone's monthly bill.